about me. So I recently had a 1-year-old, which is, I know, well, a big deal at this point. I have 2 dogs, 1 cat. I moved here in Lincoln in 2015 to go to college. I was originally going into accounting. I eventually fell in love with accounting when I went to get my associates at SEC. Ended up getting my bachelor's from Bellevue in 2019. I started working in accounting in 2017, and a couple of you know where I started my accounting journey at a small firm here in Lincoln. And I ended up working with Josh for, I think you came the first year, almost the first year I started, so 5 years now.
Wow.
I've been working with him ever since, massaging, getting the right ways to get real estate accounting and a little more in depth so you can understand your numbers. I grew up farming, so real estate's a big deal to me. Eventually I'll have some farmland, hopefully, and that I'll be able to rent out and all that stuff. But otherwise, yeah, that's how I got into accounting. Whole reason I kind of wanted to open up my own business, I started in, was it May or June? I met with Josh, asking him about an idea that I had for a business. And he said that'd be a pretty good idea. So I went ahead and started doing it. I was working a full-time job, working 50, 60 hours a week already. Eventually I got a couple more clients. Job was getting a little too stressful. So I decided to go full-time with my accounting. So thankfully I've had a group of people that have stuck by me and helped to make that possible. So
I'm Jenny Lindblad. I have 2 kids, 2 cats, and 2 dogs. And I grew up in Dorchester, west of here. I spent the first 15, 16 years of my career in insurance claims and hated every minute of it. Finally decided what I wanted to be. Went back to school for accounting, and my first accounting job, I met with Becca and worked together for several years. We both left there to go pursue different things. I took a job in public service, and when Becca invited me to join her on her Bachelor with Real Accounting, I was more than excited. I'm very jealous of all of you that have left your W-2 jobs, but I still have mine, but someday. Looking forward to it. So I will let Becca go ahead and get started with talking about bookkeeping, and I will follow up after that with some stuff about payroll.
no? Yeah. Fun. Okay, so a few things that I kind of wanted to make a point to let you guys know is that a lot of people think bookkeeping isn't always a big deal. You can do it at the end of the year, great. It takes a lot of time if you do it all at one time. So I wanted to point out some beneficial information that can help you why bookkeeping is important. So it helps monitor your business progress. So how many of you like to know how much you make before you pay your taxes? How many of you like to know it monthly instead of just a couple of months before taxes? Okay, that's a big one for a lot of business owners. I even do it for myself. Even when I just had a W-2 job, I would go in and see how much I'm going to possibly make by the end of the year. Another thing, it helps you prepare your financials. Now, if you don't do I don't know how hard money loans work, but I'm assuming they probably want to know how much you're making, or at least bank owners do. So you're going to need financials like balance sheets and profit and losses. Well, if you're not doing a monthly bookkeeping, you're coming up with those financials possibly accurately to give them so you can get that loan. It also helps you identify your income sources. So if you don't separate your income separately from bank account to bank account, say you're just using your personal bank account as your business bank account, it's gonna help you verify how much is personal, how much is actually business. So, and then it helps you obviously track your deductions, your property's basis, and helps you prepare tax returns. So it's gonna help you show what your net profit is. If you have rental properties, like most of you do, you're gonna wanna know how much money you've put into a building. So that way you know how much you're gonna sell it for. And then also it helps support your tax returns. If you don't keep all of your receipts, this is something that you can fall back on and be like, okay, if you have an accounting software, you can go in and click what transactions go into that category. So I've been working with, like I said, I've been working with Josh for a long time. There's a few things that can help make bookkeeping a lot easier for you guys, not only for if you're doing it yourself, but also for your accountants that do it for you, so that way you have time to do other things. So separate bank accounts from your personal is always a good thing, because then you know that that bank account is specifically for business. You can spend it on whatever the business needs. That's no matter the business entity. There's sole proprietors, there's partnerships, and corporations. An accounting software is beneficial, but not technically needed. It makes life a lot easier, especially if they hook up to your bank account. Big thing is open lines of communication if you have an accountant. You always want to make sure they're going to be available for any question you have. Like Josh texts me, or he emails me, or we have a folder and a shared drive that he puts everything in. So I don't always have to bug him for it. I only have to bug him for it if I really need it. So, and then documentation. Now, accountants don't want the shoebox, but we will take the shoebox. Just know your bill is going to be a lot higher if you do the shoebox.
It works.
I recommend using a digital format so you can get rid of the shoebox. And if you ever do get audited, which is very unlikely, you can go back and print them off for the auditor. But then you save space. Just make sure you have enough storage. And then for a lot of real estate, we want to do it per property. And that has everything to do with your tax return. Like if you want to know per unit, great. You can do that. That's totally a preference thing. But for tax purposes, it's going to be a lot easier to do it per building. Now, a lot of you probably know this. Some of you probably don't. There's two ways you can understand you, or what's the right word? Do your bookkeeping. There's cash basis and there's accrual basis. There's two types. A lot of people do the cash basis because it doesn't take a lot of effort. It's literally coming in and going out of your bank account. Some people say they want to do accrual because then they can take into account expenses for the year that they're going to pay next year. So accrual is when you earn and get the bill from either your tenants or your contractors. And then mainly the income you have coming in obviously is rent income, gain on sale. If you're doing flipping, you're gonna have the sale income. Those are your main incomes that any real estate person has. Otherwise, if you're in other things, there's other types of income. So I know when I started working with a lot of clients, they were always asking, what's the difference between an expense and a capital improvement? Now, capital improvements can be expenses if you 179 them and do all that fun tax stuff. But main expenses are gonna be overhead expenses and items most accountants do under $2,000. Unless it hits one of the rules of like you're adding to a house and so you're doing multiple things to get there. So your electrical bill is only $2,000, but you also have the plumber, all those other things that are going to go into capital improvements. And then a big rule of thumb is if you're replacing 30% of the property, safe bet it's going to be capital expense. Some other things that might come into question when you're like, well, how much is this expense or how should I go about it? Auto expense is a big what if question, or which way is better. So there are two ways of doing it. There's the mileage and there's the actual. Now, if the car is used for personal, you will actually need to keep track of how much you use it for personal. If it's 50%, or if you do it by the mileage, you get the federal government comes up with a standard deduction that you get. But the rule of thumb is if you're an S corp, so if you're doing flips and you're not doing actual, just filling up your car, you need to pay it out to the owners. It can't just be a contribution or something like that. It needs to have documentation that the money went out. These are things like if you're doing only mileage, it takes, you can have other expenses that are related to auto as an auto expense on top of just the mileage. The mileage just takes care of the gas, oil, tires, mainly anything that goes in the vehicle. So if you're doing like toll roads or something like that, it'll be added on to that. Actual expenses, you're calculating up all your auto expenses you did for the year, and then you're timing that by what you use it for business. Unless you say, hey, a lot of people do it this way, is they use the business card one time, 2 times they do a personal card, next time it's business, so on and so forth. That makes it easier for some people, so that way they don't have to also track their miles. Buddy. Any questions so far? No, we're going pretty fast.
Is there any benefit to leasing versus like car payments or owning expenses?
So leasing, it would still be how much you use it. If it's fully a business vehicle, it's a great option. If it's both for personal and business, then you still need to do that 50-50 of like, hey, I use it 20% for my personal stuff.
Why is it a good option for leasing?
Because leasing can be, so if you have a loan on the vehicle, you're only getting that interest expense, whereas the lease is a full-on expense. So instead of, say, the interest was $100, but the lease was $400, you're getting the extra expense of $400 instead of $100 of interest on the loan.
Gotcha.
And then I'm not 100% sure on how leasing works, but then you don't have to worry about, I think they're supposed to make sure it gets repairs and everything.
Great.
So, yeah.
Depreciation then, obviously, on the lease,
Yeah, you don't have to take depreciation on a lease, it's just expense.
you don't get the
Yeah, because it's not your vehicle unless you, like, I think most leases is you can end up buying it for a lower amount at the end since you already paid so much.
So would it take in bonus depreciation if they'll get more than like taking more of an expense on your lease payment?
It can, depending on how fancy the vehicle you got. But also, I went with how stuff's going with the IRS. You're not gonna have bonus depreciation for very much longer. Maybe 3 or 4 years for a decent amount for bonus depreciation, but yeah.
And do you rate a vehicle as like a call for business? Do you need to have another vehicle to say like this is my personal car?
If you have a spouse, no, I wouldn't say so, no. Another great thing about, I've learned over the last couple months of doing extra research is if you say you bought a vehicle and you decided you wanted to do it as an asset and put it on there so you could get the depreciation, you have to do actual expenses for auto expenses until the life of the vehicle. So you can't switch from mileage to actual. If you do mileage the first year, you can go back and forth, but not if it's actual the first year of the vehicle's life.
What do most of your clients do?
I think most of them just do swipe the card when they need an auto expense. And I think it's so close to my vehicle there. So some of you do rentals, some of you do flipping, so I wanted to kind of give you a split of what each bookkeeping or accounting processes go in. So rentals, like most of you know, they're passive income. Unless it's a short-term rental, it can sometimes be active income. Otherwise, and it's usually placed in LLCs to protect the property, your personal property, from getting sued from the tenants. It's usually reported on a Schedule E if it's a sole proprietor or joint venture, which a joint venture is if you're married. You can still have it on your personal returns. Some states you have to actually file a partnership return. And then claiming expenses are pretty cut and dry. You have insurance, all that fun expenses that I'll get to later. Whereas flipping is active income. You're actually going out there, making the money, getting it towards you. I would recommend I have an LLC since there's a lot of things that you could go wrong with flipping. And it's usually reported on a Schedule C, which is just a form that basically shows the profit and loss to the IRS, or a S Corp return, which is 1120S. Now, you can start off as a Schedule C and switch, but you want to get with an accountant to know when to change to make the tax benefits the most advantageous for you. Because a C Corp, you're gonna have self-employment tax, which Jenny will talk to you about. And then a thing to really point out for flipping is some expenses can be pushed off to the next year if you're still working on that house. You just have to be able to say, this expense is for this house. and I'll give you a list of what those expenses could be. Pick here. So flipping expenses that can be pushed off. After I left my small firm, I actually did a lot more digging onto what expenses can be pushed off. It's a lot more than I thought. So you can, as long as you can break out each of the transactions or property, you can push insurance, utilities, obviously improvements and closing costs, and the interest paid on that property to the year you are actually selling that house. So say you spent $25,000 in 1 year. Some of you, I know that's a really low number, but you don't sell it until the next year. Well, if you claim those in that 1 year, it's gonna look really bad because you're taking $25,000 on something you haven't even sold yet. So you pull it over, say, hey, I sold this house now next year for 150, bought it for 100, only did 25. Well, now your gain on that is 25,000. And you can keep doing that each year. The key is just you have to be able to show which property it goes to. Any questions?
What can't you roll into the next year? Like I roll everything into the next year.
If it's overhead costs, is mainly the big thing. So like, as long as it's touching that property, you can roll it over. So if you're doing software to take care of your stuff, obviously that's not something you're gonna roll over. So anything overhead related is considered, you do it that year. Or if you starting up just the first year and you're doing extra advertising or marketing, you can push that off. You can make it lower than taking all of it in 1 year. So say you spent, to get your business running, you spent $40,000 on an ad campaign that was trying to build up your brand. You can do what's called amortize it and break it out. Instead of taking that $40,000 in 1 year, you take it over 15. So.
What's the
What's your rule of thumb on receipts? I mean, do they all need to be saved over a certain amount? How long do I need to keep them? What do you tell your clients?
I would say keep all of the receipts that are business related, and as long as you're doing your taxes on time, they technically can't audit, as what I read, they can't audit you past 3 years, but they still say keep 5. That's why I say make everything digital, because then some businesses are 5 cabinetfuls of files for 1 year, and that's just a lot of space that you don't have. And with everything going digital, it's just easier to just snap a picture, throw the receipt away. That way you're not losing it. Because if you can't provide a receipt or proof that it was business related, IRS can take it out and say you owe more. And if you owe more, you have interest and penalty onto that at the time it was due.
What's the biggest thing you see with newer real estate people that just to get them more organized? Like, what do you typically do with them?
A lot of the times they're not sorting it by property. They're doing it in their head, but they're not doing it in their books or on their spreadsheets as detailed as it should be. So that's one of the biggest things, is knowing which property, because the picture on there was really bad, but on the Schedule E on a tax return, there's columns that separate it by property. Now, if you do everything in one column and you don't split it out, you're not, the IRS is just gonna think of that as one property and say, okay, now they're not gonna differentiate. Whereas if you're splitting it out, you're knowing how much you're making per property. So if you're like, hey, rent needs to go up, or why am I losing money on this property when I should be making some, you can be like, oh, that expense is supposed to be for another property and it's supposed to be an added thing because it's a big project. Or it's easier to find things that are wrong if it's split up. Whereas if it's just one, you're not combing through it as well.
How did your clients tell you which property expenses are for? Yeah, I mean, like if you're coding, how do you know? Do they just write it on the top of the receipt and we'll just like take a picture and send it to you?
Well, that's what you do.
I don't do that.
Some people do it that way. I try to do bookkeeping every 2 weeks for my clients, and I send them a list of transactions that were through a debit card. Because if they're checks, I ask them to put in the memo of what property it's for. That way I don't have to go about a check. If it's a debit card, then it goes into an unclassed section of a report, and I then send that off to them, and they go through the list and say, here it is. That way they're not looking at every transaction, so they're just looking at the ones they need to.
I know you said it would probably never happen, but what would cause a 20-unit landlord to get audited? What red flags would come up, or what would be wrong that would make that happen?
I mean, if it's drastic numbers from one year to the next, that's usually a big red flag. So if 1 year you're making a major loss, and then the next year you're making $50,000, they're gonna be like, what happened? So as long as you're being truthful and honest every year, there's nothing really to worry about, and especially if you're keeping all your transactions in a receipt or in a bin or in some place. So that way you can be like, okay, here you go, dig through it.
What are some things that we could write off that no, that's not write off?
So if you use your house, you can use some of that portion. If you say you're under an S corp, you just need to make sure you're reimbursing yourself for it. So I'm an S corp, and I have a spreadsheet that says, okay, this is how much I pay in internet, this is how much I pay in electricity, and it calculates how much I'm supposed to take out, but then I also have to pay myself back for it. So that way you're showing like it's not just for fun, just to get the expense, you're actually paying it out. I think a lot of people don't quite understand how the business use of home office works, because it's not just a portion, it's not just all of it, it's a portion, and it's a big thing is to document what room is your office.
So like the friendly, softly, and correct.
I use QuickBooks Online. I know some people are worried about money, and I've done a couple research on what works for real estate properties, and they say Wave is a good one, and you can get that one for free. I technically wouldn't, but if money is your issue, then Wave is a way to go. Otherwise, you can use Xero. It's a little bit more expensive than QuickBooks, and I don't personally like to use it just because it's clunky, and how you reconcile it to make sure all the transactions are in there is way different, and not how I would reconcile a bank account. So I use QuickBooks. You can use the desktop version or the online version. If you know an accountant, they get a discount, so they can probably share it with you if you want to look into it. Any other question?
You were talking cash versus accrual.
Yeah.
If you buy something on like a revolving account, you're paying for it over time. Do you write it all off? If you're on cash, do you still write it all off on the front end, or do you write off each month?
No, so that's a good question, because if it's a revolving account, it's treated as a liability. So you're doing the expense when you buy it, and you're showing that you have the asset for it or the expense for it, plus a liability of that amount. So it's saying you bought something for $50,000, you paid a couple of months off it. Some of it was interest, some of it was principal. And you're showing that you still have a $30,000 loan. You have a $30,000 loan on it saying you still owe money, but you get to write off the actual expense in that revolving account the day you make it, and the interest whenever you make the payments. Even if it's cash or accrual.
Okay.
Accrual only is if, so say you send an invoice to someone for their rent for $800. Well, they don't pay it until 2 months later. Well, for that month, you're still saying you're claiming that income, but say they don't pay it until the next year, you can offset it with non-collected rent to decrease your income. But with the expenses, like say you bought an HVAC unit in December for $5,000, that's really, really cheap. You can claim it that year instead of pushing it off to the next year when you're gonna pay it. So if you're like, but you just have to be consistent. You can't just go back and forth whenever you feel. You just have, once you start, you pick one. If you're like, oh, I wanna try, if I actually did it this way, I would save more money. You can switch. Just, if you flip-flop back and forth, it's gonna look a little suspicious. Any question?
I got a question here. So to the bookkeeping, I can do by myself. I can hire like you guys do it. What's different?
So a lot of times it comes down to what if you're not understanding it correctly. You might be coding something wrong or making something you're not supposed to, or you don't really like doing it, so you just want to offset it to someone else. Or, hey, you could be making more doing something way different, doing what you want to do instead of this. How many people actually like sitting down doing their books? Nobody? One person. One person likes to do it out of 45. So,
do it every week. For every unit, and this kind of take picture for all receipts salary.
Yep, that's a good thing to do. But it takes up a lot of your time when you should be going and looking for a tenant for a building, or buying a new property, or just doing something else with your time that can make you more money. When you push it out to someone else that one likes doing it, went to school and knows how to do it correctly, can explain it to you, to say, hey, here's the deal, and they can tell you what you might end up owing at the end of the year. Whereas, yeah, you're doing the bookkeeping, you're saying, oh, I make $50,000. Well, do you know what that $50,000 is going to push over to your tax return? right away. Most people want. So that's why a lot of people just push it out or contract it out. Any other questions? P10.
I'll take that.
I have Alex.
I will preface this by saying I took accounting because it is a great career for introverts and socially awkward people. I am both. So excuse any awkwardness. I am glad to be here despite how uncomfortable I look. And what I am going to talk about today is starting yourself on payroll. If you're already doing this, then you probably heard the spiel when you started it, and it's all going to make sense. If you're not doing it, you may need to be, or it's something you may need to think about doing in the future. So, should you start yourself on payroll? Why should you do it? When do you want to start it? How much do you pay yourself? And how do you get that started when the time comes? So a couple of the simple reasons why you should take payroll. It helps with budgeting, personal budgeting. If you're one of those people that has to have numbers there in front of you to avoid overspending, like me, it can help you with that. You're getting a paycheck, even though you're in control of it. You still have set those parameters for yourself. You're able to pay income tax in with every paycheck, so that will help you come at the end of the year. You may not be having to pay in that huge tax payment when you file your taxes, or you're not having to make estimated payments quarterly. It's just coming out of every paycheck without you seeing it. And most importantly, it is going to save you money on taxes. When you're not taking payroll and you're just a Schedule C or sole proprietor or partnership, you're paying self-employed income tax, self-employment tax on every dollar that the business makes, whether you take it out or not. If you're taking payroll, you're going to pay a lot less those taxes because you do not have to do the self-employment tax. So how does that tax benefit work? And Becca kind of touched on the business entity types, the sole proprietor and the S Corp. Kind of a little how it is. I'm sure most of you know like the LLC and the protections it can provide. But the other thing, an LLC itself is not an entity that's recognized by the IRS. By default, if you're an LLC, the IRS recognizes you as a sole proprietor and you're going to file your taxes on a Schedule C. You can choose to be treated as a corporation, an S Corp, by the IRS. You have to make some elections. We'll kind of talk about that. And in that case, you start taking a salary. As a sole proprietor, you cannot take W-2 wages for yourself. You can still pay employees if you have them, but not yourself. You have to take owner draws. If you have a partnership, you have to take distributions or dividends. And as an S Corp, you do have to take payroll, but you have to be an S Corp too. So as a sole proprietor, you're going to pay self-employment taxes, like I said, on every dollar that the business makes, whether you take that money out or not. At the end of the year, you look at what you brought in, all your expenses, that bottom line is going on your personal tax return, and you're going to pay 15.3% tax on every dollar of that. That is not an expense to the business. The business doesn't get to write that off. You don't get to record it on your books the following year. That is your responsibility. As an S Corp, if you're taking payroll, the business is going to be paying those taxes. It reduces the business income, and what's left at the end of the year will still flow for you to your return. you do not have to pay self-employment tax on because it becomes passive income. It's the money that you make just simply from being the owner of the business, and you've already paid taxes on the work that you're doing. You may still have to pay income tax on it. That's the one that becomes on how many kids you have and your total income, but you don't have to pay that 15.3%. So when should you start? If you look online, there's all ranges of different recommendations. Some sources will say once you're making 100,000 gross revenue, or when you're making 50,000 net, or 60, or 30, or 10, or just start from the beginning. What it comes down to is when it's going to save you money, because if you're just a sole proprietor, you don't have an LLC, it's going to cost you to establish the LLC. You're going to have to get the S-Corp election filed. You may have to pay somebody to do that for you. You're going to have to pay to have that payroll processed every month or week or quarter. And you're going to have to file a second tax return for the business. So there are costs associated with it. And you just got to weigh those costs with what kind of money you're going to save on your taxes. So this is kind of an example. Numbers. In this case, this person, say, is pulling in $75,000 gross. Assume your accountant charges you $50 a month to run your payroll and an extra $400 at tax time to process that S-Corp return. So your expenses go up by $1,000. You take $25,000 in salary. Those payroll taxes, both your portion and the employer's portion of the Medicare and Social Security, are going to come out of the business account. You'll have some federal unemployment and state unemployment, but it's really nominal. Your net income has gone down by $30,000 as far as the business and what flows through. You're not paying that self-employment tax of $7,000. Your total payroll taxes have gone down by quite a bit. So even though you're spending an extra $1,000, you're still saving over $2,000. So in that instance, it would be beneficial to make that change to an S-Corp. It's not something you can change back and forth. So once you're ready to make that, you're going to have to stay, I think 5 years as an S-Corp if that election stays. So the next thing that we'd have to figure out is how much you want to pay yourself. Some people will ask, okay, can I switch to an S-Corp, pay myself zero salary so I don't have to pay taxes on that, and it's all passive income at the end of the year and I don't have to pay self-employment tax. That is something that will get you audited. That's a flag. They can come back and see that, and they can say, you were an S-Corp for 2019, 2020, 2021, and you reported $50,000 in business income as passive income, but you didn't take a salary. We're reclassifying all of that. You're paying 15.3% on all of that plus interest and stuff. And it's kind of a nasty letter that they send. So you definitely don't want to get on that radar. The IRS says you should pay yourself reasonable compensation. They give a 2-page explanation of what reasonable compensation is, and it is not an answer by the time you get done with it. They say you can look at things like what you would pay, what you pay your employees, you should probably make more than them. What you would be paid working for someone else doing your duties, your experience and training, or the time that you spend, or my favorite one and the easiest one, and what we do for ourselves is the use of a formula to determine compensation. You can say, right now, as of this year, I'm on track to make $50,000 net by the end of the year. I'm going to do half of that in the payroll, The other half will be draws. There's your formula. 60/40, again, there's all kinds of suggestions, recommendations. Every resource is going to give you a different idea, but look into it and decide. So once you're ready, how do you start? We've already talked about forming an LLC is the first step. Obviously, there's way more benefits to it than just starting payroll. You'll need to file an IRS form telling them, yeah, I want to be treated as a corporation. There's rules about when that can be filed. If you just form your LLC today, you have 2.5 months to submit it. You can be treated that way for this tax year. If you don't do that within the first 2.5 months and you wish to change the following year, you can file it anytime this year to be treated that way next year or within the first 2.5 months of next year. Then to be able to start that payroll, you'll need to obtain some state federal IDs, select a payroll provider or some software to run that, figure out your dollar amounts, and then it just runs itself. That's all I have on payroll. Does anybody have any questions on that?
About ready?
Okay.
Also like C Corp. So if I'm people running the business with this, so I either pay the W-2 or pay the 1099. Which one? I don't know.
For yourself, you'll need to pay, as a C Corp owner, you'll need to be W-2.
Can I pay the 1099?
To yourself, yeah.
No.
You'll need to pay the, yeah. Yep. That beat. Any other question?
It's not like, I don't think we talked about it at all, but I keep hearing about how you use it, like, you have kids, you pay your kids to work in your business to do, like, they could read you or whatever. And you can pay them like up to $13,000 and such and such, tax and approval, no checks for them. Can you share about more help?
Yep, you can pay your kids as an employee. There's different, the only difference between paying them and a regular employee as family members, there's, they don't have to pay, I think, unemployment tax or some of the other taxes on that. So you can do that, and as long as you keep it under a certain amount, they don't have to file a tax return.
So when my kid is 3, but he sometimes helps us, turn over our Airbnbs, like we could assign him a reasonable salary. It takes deduction for us that we turn, right? Really? So there's no age requirement.
No, not if it's your child.
And is there any age cap?
Documentation. You would need to be able to find and that the substitution stop.
Yeah, show some evidence that been forced in their 5-year-old.
They can I do it. You need to make sure you're showing doing something. They're doing the dishes.
They're doing it's not
Yeah, they're doing
directly.
something that just shows we're actually doing.
Is there an age cap though with that that stops?
I believe that I could check and let you know for sure. I believe that would go along with kind of the age to where they can be claimed, not claimed, depending on college and how much they make.
Instead of clocking the kid in and out of the Airbnb, couldn't you raise them up as an advertising influencer, put it in some of your ads?
I think you probably could. You've got ads with your kid's cute little face on there saying, come stay at my dad's place. And you're paying him for using his likeness and image.
NIL, baby.
Yes. Okay.
heard that you have like CAs and you buy a property, they can avoid tax or something. Is that true?
I don't know necessarily how that would work. I guess it would depend a lot on the circumstances and the value of property. If you're buying property and gifting it to your children, you may be responsible for some taxes on it, as far as it being gift taxes. So a lot of it would just depend on the situation. If there's income generated from that property that's more than $400, then the child would have to do a tax return. So if you bought an investment property or rental property in their name, they're going to have to do a tax return. And the IRS set it up that way so that parents couldn't hide their assets and their kids' savings.
Even they only can, then they have to do tax return.
If they make more than $400 in passive income.
So the second question is there any way for us to take no months in case go travel, like example, we want to go to other state to look to buy property and we can claim expenses, but I don't have any like flows or the contract if that any stuff.
Save any information that you can. If you meet with a realtor there, save their card, save, the MLS listing, the listing for it, documents. You could take photos while you're there, just anything to show that this is what we did while we were there. Then if you travel, go look at a property in Vegas and you stay there for 4 days to look at one property, that's probably going to be, you can still write off part of that, maybe one night of your stay and your travel, but you couldn't include, say, your children's travel and 3 more nights and 3 days of meals.
I do all that I'll have.
All right. Anything else for Ian or for Becca? Oh, yes.
I have a question about our C Corp versus S Corp.
Okay.
Which one do I have to be?
Both of them, you will have to, any corporation, you'll need to be taking a salary.
Oh, I've gone C Corp. I've gone to my something that's as an owner.
Yes. There would be, and we have them up, but I'm pretty sure they still have to take a salary.
The ones that they're money, yes, they were recommending salary. The difference between a C Corp and an S Corp is S Corps are a flow-through entity, which means it flows through into your personal tax report. And so, and a C Corp pays income tax, a corporate tax, the IRS itself. So when you're doing a C Corp and you're making your own payroll, you're paying, technically, you're almost paying taxes twice. That's why a lot of people don't see C Corps around very often unless you're like a really big company. But you can't also transfer a C Corp over to an S Corp with another form that's not the 2553, but it's similar. S Corps, you're paying yourself a reasonable salary to get out of that self-employment tax rate. So that way you're not self-employed. C Corps are also taxed directly. Their bracket are different than an individual.
So as a foreign, you better have C Corp, right? I mean, it's either that or
That's going into formation details and more
clear.
Yep.
Have you ever used deduction where you can brace your own house out to your corporation for annual meeting and take, so let's say in their town you have a So place and charges $200 a night for a room. And you get 13 or 14 days, you can do that for a year. Then we're familiar with that. And
I am familiar with it. I've never personally done it. Yeah, if it goes over a certain amount of time, you've got to claim rental income on your own personal taxes. It can be done. I haven't done it personally.
okay, just another deduction with on that amount.
Yep. In one that you'd want to save documentation if you're, if your members are traveling in, if they live next door, you probably don't want to do that.